Well, investors are still worried about uncertainty over trade as tensions between the U.S. and China continue to mount. So what's the downside risk here of the trade war? Well, joining us now to discuss all of this is Stephen Rees, a JP Morgan Global Investment Specialist. And Stephen, when we try and evaluate what the downside risk is for the trade war, from your perspective, are we talking a possible recession?
Difficult to call. I think the downside risk is that it just doesn't get settled anytime soon. So it's really the uncertainty that's pressuring multiples. But the uncertainty is actually creating a lot of opportunities. Our base case scenario is that it actually gets resolved. When, I don't know exactly. We do think it gets resolved at some point this year. But the uncertainty around that and the volatility it's creating, particularly in the technology sector, is creating some pretty interesting opportunities.
Are you talking semiconductors, some of the chip stocks that are exposed over there, or where are you seeing that?
All of the above. I think a lot of the high-quality mega-cap technology companies have come back. As of last week, we were getting closer to the lows that we saw last year, and I think right now, the sentiment is quite negative there. A lot of concern around whether or not these companies will be forced to break up. I don't know if that's actually going to happen. If it were to happen, it doesn't necessarily mean that it would destroy shareholder value. So we're trying to step in and sort of take a longer-term view, looking for the good growth areas in technology, whether it's mobility or 5G or cloud computing. There's a lot of growth out there that I think is really, really interesting.
If we do get that deal that you're talking about, and you're saying it would likely happen before the end of the year, do you think it could reverse some of the damage that has been done in the markets?
Absolutely. I mean, we do have to keep in mind we're up 16% year to date for the S&P 500. So I don't know how much of that negativity is priced in. And in fact, I think in the very short term, we probably do have some risk to the downside. I think it's going to be a volatile, range-bound market through the summer. But depending on where we end up in the end of the summer, I do think there is a bit more upside to the market into year end. But also keep in mind, we are later in the cycle. We are looking at 5% earnings growth this year, hopefully 4, maybe 5% again next year. And with valuation sort of at 16 to 16.5 times, I think that feels about right. We're kind of playing for the earnings upside in the market at this point, but better growth.
One of the big things that you were talking about just in terms of what could be ahead for the markets is the Fed's next move. A lot of the talk out there has been the fact that we are still up about 16% so far this year is because investors right now or traders are pricing in a rate cut. More than 3/4 of economists surveyed by the Wall Street Journal now expect the Fed's next move to actually be to lower interest rates. What are you expecting to see from the Fed?
Yeah, I think as a firm, we are expecting one possible rate cut this year that is lower than I think what the market is currently pricing in, which is about 3/4 point cuts from now until the end of the year. I don't like the way the market is moving up on the expectation of rate cuts. I think if they do cut, it will be more of a insurance cut to say, perhaps, they won't admit it, but maybe we raised too many times last year and just sort of to give the economy an extra bit of boost. But we're looking for one cut this year.
Do you expect, what's your outlook just in terms of overall the U.S. economy right now? Because we got that weak jobs report out last week. Some of the other data that we've been getting recently has been a little bit mixed. I know a lot of analysts out there, a lot of market watchers are saying that growth is expected to slow. I guess how big of a slowdown are you expecting?
Yeah, we're looking for it to slow to call it trend growth of around 2%, maybe slightly lower. But again, it depends on what happens with the trade deal with China. It depends on what happens on the Fed. But we're not calling for a recession anytime soon, and perhaps not even next year, which is why, from an equity perspective, we're still most confident staying overweight the U.S. and really taking advantage of the pullbacks that we see this year in places like healthcare and technology.
Is there anything that we haven't discussed that could be a trigger to the downside for the market? So we've been talking about trade, we've been talking about the Fed. I mean, if they do something out of the ordinary, what traders aren't talking about, and hike rates, obviously that would spook the markets. But outside of that, is there anything else that you're keeping an eye on?
I think, corporate profits, obviously there was a lot of fear that corporate profits would slow down this year, but they've actually been quite good and better than expected. So we'll be watching very closely the upcoming earnings season. Also signs of inflation, which has really been non-existent, but to what extent the current trade war has on inflation, I think will be important to market, because for the market to go higher, we have to achieve that earnings growth next year. And if we start to see some inflation and slowing demand, we could see some risk to the downside for earnings growth next year.
All right, Stephen Rees of JP Morgan, thanks for joining me today.
Great to see you.